Good morning, everybody. It's Sunday morning, 8 o'clock. This is the Money Matters Show. We do appreciate everybody that listens, either live right here on the radio or listens on iHeartRadio apps or wherever you're listening to our show, podcasts. If you're listening to it day 2 or 3 weeks later, that's great. A lot of people have been listening it, and, we're going on 35 years, almost 34 years of doing this show. 34 years. And I look at what's going on today, and it's like you get this feeling every once in a while. And that feeling is this market going to stop going down? Is the world going to continue to be such a mess? Where are we going to be and how are we going to get going? And what do I do with my money? But there is an indicator that I'm going to tell you about that's very interesting. And it's that fear indicator that comes from clients. And remember, the whole thing is risk-reward. I want to tell you, too, where we are in the risk-reward. I've been talking about for the last few months that the risk was greater than the reward. So where are we? These are things in the next 20 minutes or so I want to discuss. I want to tell you why I believe the market's going down. I want to talk to you about where our support levels are. I want to talk to you about what we are doing, what we've done, what we're doing, what we're going to do. Because if you don't have a plan, it's not going to help you. A plan keeps you from panicking. A plan keeps you from doing things at the wrong times. Fear and greed. And you need advisors that are going to be able to help you understand your plan while you're panicking or you're having emotions of fear or greed, happens on the other side too, that are strong enough to tell you no. And that only comes with experience. And we have the experience. The show that's been going on 34 years now has been brought to you by Greenberg Financial Group. Greenberg Financial Group is both a registered investment advisory and a broker-dealer registered with the SEC, members of SIPC, and members of FINRA. We talk about a lot of things on this show. We talk about different strategies, ideas. We talk about geopolitical, political. We talk about economics. But everything has risk. Everything has risk to your money, to your portfolio. And you need to understand every single time what you're investing in, why you're investing in it, and the impact that things have on it. The biggest impact you've had lately has been interest rates over the last few years. If you just stayed in those long-term bond funds, you have made a mistake because those things are not only down last year over 20%, they're down this year another 20%. That because bonds are supposed to help your portfolio, but if you don't know what type of bonds you're in or what you're doing, it can hurt your portfolio when rates are going higher. So what do we have right now? We have the Dow Jones this week down over 2%, the S&P 500 down 2.5%, NASDAQ down 2.6%, and the equal weighted S&P is now down 2.4% for the week. For the month, the Dow is down 3.3%. The S&P 500 is down 4%, NASDAQ's down 4.4%, and the equal weighted is 5.6%. Remember, the equal weighted is where most people, when you're looking at a balanced portfolio, there, because you don't only in the magnificent 7 stocks of technology, the big tech. That's what drove the market, the S&P, from the beginning of the year. That got it up to 18-20%. Well, those same things that have moved up, moving down. The Dow for the year now is down 2.2%. The S&P now is up 7.2%. NASDAQ, that was up almost 38%, is only up 20%. Sounds good, but it is down from the highs. The Russell is down 7%, which is more of a smaller cap index, and the equal weighted is down 5.3%. I bring that up because you can't just compare yourself to the S&P and the NASDAQ and the Dow. You got to look at what's the most stocks. The equal-weighted S&P is down 5%. So most people's portfolios, when you look at it, you might be down a little bit. Equal, you see where it is from that standpoint. All right, so what's driving this market down? Not too far recently. We were, about 45, 4,600, looking to break out. Last 3 months down, August down, September down, October down. Why are they down? Well, it started with, obviously, overvaluations. And now you're at the situation where there's been breakdowns of support. So technically we've been breaking down. Then we get selling on top of that. And now we have all the worldwide geopolitical input that's creating a real problem. And then nationally we have inflation. And we have a strong economy, and we have good earnings, and we have the Fed talking next week. So where does this all put us? Well, right now the S&P 500 is now closed down at the 4,117 level. There is some support right in this area on the S&P, 4,100. If it breaks down, I can see 3,950 to 4,000 being in an area that could be bought. On the upside, you got some support, some resistance right as all these other support levels, 4,250 to 4,300, and then you got to keep going. I don't see us rallying past maybe 44, 4,500, but that is only under the understanding that things are getting better in the Middle East. Right now, people are afraid of an escalation in the Middle East, which is offsetting actually very, very good earnings. I like the earnings that are coming out. All the tech companies surpassed what they thought were going to be earnings, but everyone saw a little bit crack in something, and they were selling them off. NVIDIA, Meta. The only one that went up higher and stayed up was Amazon, Microsoft, Apple, all of them up and then down, okay? Because that's where the psychology is right now. The psychology is to sell off until we have a better playing field. But you know how these markets work. When you feel comfortable, the markets have already hit the bottom and turned up, and then you're waiting for a better buying opportunity. We invest on a risk-reward basis. That's how I look at it. I've been doing this for a very long time. Is the risk greater than the reward? Is the reward greater than the risk? Well, back in June when we were hitting, the 4,550, 4,600 level and stuff, I said, I'm not comfortable with this market going into August, September, October. I'm taking money off the table. I'm mitigating risk, and I'm going to go ahead and wait it out because I believe the risk was greater than the reward. And it was. Turned out right. Well, now where are we? To me, we're balanced. Maybe a little bit more riskier because of what's going on, but definitely the risk side has come down and the reward side has go up, but not enough for me to say go in and start buying. There's not enough there that tells me, yet I feel comfortable, this is the bottom, and let's go. What it does tell me, I'm looking for a bounce bottom, which means, do I think we can come off this 4,100 level or so if things don't get worse in the Middle East and move back up, 3-5%? I do. And I think that's what I'm looking for, that opportunity. So how do you play that from here? You play that, you invest that way, because if you had the cash on the side, right, and you're mitigating risk, and you mitigated risk by raising cash, reducing positions, by buying the inverse funds, buying insurance puts, selling calls, right? That's kind of how you mitigate risk. That does not mean you don't lose money. You do. But you offset some of the losses by being in some of these other things while the markets drop. Well, to take advantage of that, you need to lessen your mitigating risk. That's the one thing I would do right now. And that's what we've done. We've been in the SDS, which is the invert for the S&P 500, and we've taken off approximately 2/3 of our position and brought it down to what we feel is a comfortable position that if it's coming down lower, we'll sell it off and move on. And if it goes back higher, we have the opportunity then to buy in low on the SDS and look for other opportunities. We also look for some stocks that we thought maybe are opportunities here that we can maybe take advantage of, or maybe the indexes, rebalancing the indexes or models, just to go ahead and participate, but not at where I say, oh, the reward's greater than the risk. We're balanced right now. And in this environment of being balanced, I lean towards the risk side of Let's take off some of the how we mitigated risk, which will reduce our positions on the short side, which means we won't make that much money if the market on those things the market's coming down. But if the market bounces, we're not giving back what we had on the mitigating risk side, which gives us an opportunity to participate to the upside. I do believe we are setting ourselves up for maybe November, December, move higher. Maybe. I don't know. We'll see. Last year in December was terrible. We got clocked. All those good companies got killed, and then they rallied big. If you remember a year ago, Amazon and Google and Apple and NVIDIA, they were down in the low hundreds and under 100, and Microsoft's in the 200s, and Apple was about 118, 120. NVIDIA got down to 110, 118 until they took off. Earnings, as I say, have been good. That is very good. I like to see earnings good. The GDP number was good, 4.9%. So there is some good reasons to believe the underpinnings. But does that mean the Federal Reserve, and this is the fly in the ointment, are they going to look at it and say, I got to raise interest rates more? If they do, that's terrible. If they just say, listen, it's too risky for us to just raise interest rates here. We see that inflation's abating a little bit. The economy's still pretty good. That's a nice little combination there. Oil prices are still high, but they're livable. And let's see what's happening in the Middle East. Because the worst thing they can do is raise interest rates. Middle East escalates. Next thing you know, oil jumps to over $100 a barrel, and our economy dumps. Nobody wants that to happen. Do I think they're going to lower interest rates right now? Absolutely not. Do I think they can put a halt on it and see what happens? I do. I think what's going to happen is allow that to happen. We're going to filter through this. And my only thing is, if we're going to be in war, we're going to be part of this thing going on. Let's finish it. Do not make it a Vietnam. Do not make it an Afghanistan. Get done with whatever you're going to do and figure out, now we are the toughest. If you're coming after us, you better watch out. Don't pussyfoot around. But an escalation, will be a problem. So, where are we going? The monies we're taking off some of the things, if we're not finding opportunities for certain people, some of the growth stocks will come down. And if they're already invested stuff, we put it in the money market fund, earning over 5% right now. If you can get over 5% in the money market fund while you wait to see what happens, it's a perfect place. But that's also been increasing over time, not just with us, but across the board with a lot of investors. That is one day going to be unleashed. Now, I'm not in the situation that I look at and say, oh, I'm the fear of missing out, because as the markets are giving me opportunities, I will look to be able to purchase some things. If it starts breaking out, that's a different story. Add on. If it doesn't, then we'll go from there. But I want to make sure that I have cash to buy if opportunities arise and markets continue to go down. Now, short-term bonds have become a big, big part of our investment philosophy right now, because we can get over 5% for short-term government and corporate A-rated plus bonds. That is a great thing. 1 year, 2 year, 3 years, we get an average over 5. So we've increased our fixed income portfolio, especially with the idea that even if we have a bounce here, I think we have a problem into 2024. Don't know why, don't know when. I do think that some of the regional banks, not the big banks so much, but the mid-sized banks and small banks could have very many problems, especially as real estate loans start coming due, and they're at 5%, 4.5%, 6%, and they're going to be moving to 8, 8.5%, maybe even 9%. Now, the seasoned real estate investor, the one that's been around a long time and has money, they're going to be able to do it. They have good properties. They have income. The ones I'm concerned about is the nouveau rich real estate people, and it happens all the time. I watched it in 1988 to 92. I watched it in 2004 to 2010, and the cycle continues. These people get rich. They're young. They can't do no wrong. They become millionaires. They're above themselves. They're pounding themselves on the chest, and then they get kapooed because of things that they can't foresee. and interest, and then real estate starts becoming a problem because if their mortgages go up and they don't have the money to pay the extra because they don't have the reserves, and people start pulling out and not paying rents, there's where your problems start and begin, and also end, because then the banks have to take back the properties. People go bankrupt and go from there. We also have a problem with savings. Our savings has been going down and down. And people go, well, they're spending money. Well, why? They're spending more money because of inflation. I was listening to CNBC in the morning, and they're making all these reasons why savings could be going down, and they tried to actually come up with a concept that said, maybe some people just aren't be affected. They feel pretty good, and they're just taking money and they're spending it because they feel comfortable that they have enough money. Another one said, they feel comfortable in their jobs because there's so many job openings that people can get jobs, so they'll take from the spendings. No, that's not it. It's the third reason that's also affecting the second reason and the first reason. They're taking money from their savings accounts because of inflation, and everything costs more money. So if the people have a lot of money and they're remodeling or doing things, they're taking from their savings and remodeling and doing stuff, that's costing a lot more. If they're at the lower end of the spectrum, they're just taking that money so they can pay their bills. Okay? Their credit cards are going higher and higher. Where are they getting the money from? You got to take from your savings to be able to pay off your credit cards, because eventually the money you're making on a monthly basis is not going to pay your credit cards off. And then it's a cycle that goes like that. I do not know why we're trying to break the economy when the economy is so strong. It's a balancing act, but we have no help from a government. The administration, everybody else comes up with all these reasons to spend money, but no reasons to cut spending. We want to give money away to everybody, but yet we still have our inflationary problems. You keep spending money, you keep giving money away, our inflation is not going away, and Fed is going to stay higher for longer, and I don't want to see that. We're going to get a normalcy in interest rates pretty soon, which means the higher rates will be higher than the lower rates. For a very long time, our lower rates have been higher than our longer-term rates, and that's an inverted yield curve. That does set up at some time that you have a recession. If that is to play out in the normal time frame, it would be first or second quarter of next year. One of the reasons I'm cautious. So what would stop this market from going lower? Earnings have been good, so that's good. That's in the back of people's minds, so it kind of slowed it down a little bit. We have to see a turnaround and get the people that are short stocks covering. That starts the impetus to go higher. We have to see a containment of this Israeli war and not an escalation of the war in the Middle East. We've got to see oil prices starting to basically top out and maybe just stay neutralized or down a little bit. We got to see a government that's finally got a Speaker of the House come together and start putting out, spending bills that make sense, not inflationary. We're going to have to do something to not shut down the government. That's the next big thing coming up, which I believe they're going to do, I hope. Otherwise, what are they going to do? They're going to go get rid of this Speaker of the House, too, if he agrees to trying to put a compromise together? We need compromises. If we get compromises, we can move forward. So the market's right now at 41.17 on the S&P. We got some support in here. I think 39,54,000, which, is another 3% down or so. There's good support there, and I hope it doesn't break that. If not, then it's going to go down to 37,300, which is, another 5%, 6% from here. Nobody wants that. Could it happen? Yes. So there's where the big question is. People say, well, Dean, you were telling us in May and June and stuff, you didn't like the markets, you thought the markets would go down. Why did you not just sell everything? My answer is crystal clear. I am not a market timer. We are not a speculator. We are not trading our accounts in and out, all cash down. We are setting up allocations of portfolios that are dependent on our client's risk reward. Now, what you cannot do is change your risk tolerance because the markets are down. And when the markets are up, change back to the fear and greed. So I know, and I told you I was going to tell you an indicator. There's a handful of clients that always love to be aggressive, but they get scared when it gets down here and they talk about selling everything. Everything's going to hell in a handbasket, but on the same token, they're talking about, well, the AI situation, the chip situation. This is good, that's good. You can't have it both ways. So the markets create fear and greed. Why we go ahead and find out what your risk tolerances is to be able to set up a portfolio of when things, in our opinion, are very, very, very attractive. We increase the risk part of the portfolio because we think the reward is greater than the risk. When the risk gets greater than the reward, when the markets move up and we have problems out there and moving into August, September, October, we reduce that risk. We reduce that risk by cutting back positions, increasing our cash position, buying more, increasing our fixed income position, hedging the accounts, buying the inverse funds, things that we do. Does that mean we do not lose money? That does not mean that. It means we will lose money, but we will make money on the mitigating risk part, which then we sell. We have more cash. We look to go forward the other way. We lose less than we would have if we didn't mitigate risk. That's all that is. At some time, you'll hear me on here, and I've been here many times saying that over the 34 years, that the reward is greater than the risk, and we're going to start investing. So what does that mean? Let's just take a 50-50 portfolio. So your 50-50 portfolio, maybe now you got 40% in one, 20% in cash, and 40% in fixed income. Markets come way down. We think the reward is definitely worth it. You go up to 60% on a balanced portfolio, maybe 65%, depending on how far it comes down. You keep your 40%, and you got less cash. Cash is king right now. Cash goes ahead and avoids the problem, but you need some fixed income because as interest rates come down, money markets will come down first, and your bond portfolio will hold you in there. By sidestepping this dramatic raise in interest rates with long-term bonds going down 20% a year, we've been able to handle and maintain basically a decent part of the portfolio. Everyone's returns are different. Everybody's returns are different. They're going to depend on what you have invested, when you get invested, what do you have in here, what do you got in there. You know, in 3 months, 4 months, it's not enough to look at. It's frustrating when the markets go down. It's frustrating for you guys. It's frustrating for us. And remember, we're on the same side as you. Our fee is based on whatever the amount of money is at the end of the quarter. So if your portfolio goes down, the percentage doesn't go high. It stays the same. The amount, the real dollars that we get are less. You have less dollars. We have less dollars. We want portfolios to go up. If the portfolio increases by 10%, we're going to increase our fees. We don't have a higher fee, but on a dollar amount, we go up because a percentage of a higher amount is higher than a lower amount. It's that simple. We're all on the same page. All we try to do, if we buy, we sell, we reallocate, we do whatever, we mitigate risk, is to protect the portfolios in order to go ahead and maximize what we can under your risk-reward tolerance. And that's where we sit. We sit in a world of turmoil and chaos right now. We will not go to total cash. We will hedge our portfolios. We will neutralize the portfolios if you ask us to, but you have to be invested because we can come in on Monday morning, Tuesday morning, Wednesday morning, next month, whatever. Things get resolved. Next thing you know, the market is rallied 1,000 points. S&P's up 200 points. NASDAQ's up 500 points. And because we were trying to catch the bottom, we missed anything turning around and going the other way. That is why we are where we are right now. Risk-reward is balanced, much better than where it was 3 months ago. If we keep going lower, then the reward will get greater. We'll let you know. But right now, we're cautious. We will invest cautiously, look for opportunities, and take advantage of any ups and downs. We'll be back. I appreciate you listening to The Money Matters Show.